We invest in restaurants, and we want you as a restaurant founder or executive to understand three key factors that drive how investors like us actually value restaurant businesses. Now, from the outside, valuations can feel mysterious, but from the inside, they're usually very logical. The first thing that I want you to understand are unit economics and how investors think about them. We'll start with a simple example. If you have three restaurants doing, say, $2 million in sales apiece, and you have store level cash flow margins or EBITDA margins or four-wall net operating income margins, whichever you prefer, of 10% approximately, that will be $200,000 in NOI or cash flow per store, or $600,000 between the three stores. That business might be worth a multiple of 4 times or $2.4 million. Now let's look at Chipotle. Chipotle generates $3 million to $4 million in average unit volumes, with restaurant level margins in the low to mid 20 range. That means a typical store can produce $700,000 or more in store level cash flow before corporate overhead, and they have more than 4,000 stores. Today, the public market values Chipotle at roughly 21 times EBITDA. Why is that? Because Chipotle sends the message that its unit economics are so strong that every time it adds a new Chipotle, it will be a cash producing machine. Most independents can never send that message to investors. And so investors feel fearful and they punish the multiple of earnings when assessing for valuation. 2, let's look at revenue growth rates. Investors care deeply about whether existing restaurants are getting stronger or weaker over time. That means flat or negative same-store sales suggest a concept might be losing relevance. But consistent growth above the market and even above direct competitors signals customer loyalty and real staying power. When you sustain that type of outperformance, multiples will shoot up a lot, which is why at DineRock, our number one metric that we pursue with our portfolio is to drive up and keep up their revenue growth rates. That's a guarantee of continually higher and higher cash flow. Third and final, let's look at repeatability. A single or a few great restaurants is not enough. Investors ask, can this concept work across hundreds of markets in different trade areas? They look for simple menus, disciplined build out, consistent labor costs, and site selection procedures and an ecosystem that actually always works. When you can achieve that and show a systematic opening strategy, your multiples can grow a lot. And if you cannot, because you have too much complexity built into your business, your multiples will be punished. Here are your key takeaways. Investors value restaurants based on the safety of cash flow, the growth of revenue, which means the growth of cash flow, and the repeatability of that cash flow across an increasing number of units. If you want to learn how to do this and to engage with a restaurant investor, you can learn more at dinerock.com.